I just don't know where to start. Joseph, let's start with you, just because I think, I would imagine your industry has had to have about as tough a year as it could have, with all of the change in how appraisers were allowed to work and how they were forced to work with a middleman and so forth. So what is the state of your industry, and did you lose some people that just said, you know what, I'm going to go find something else to do?
Actually, ironically, we still have growth. We're not growing at the same ratio, but we
Okay.
still have growth in our profession.
That's fantastic. And having the companies in the middle of the transactions, the management companies.
That's of great concern to a lot of our members, especially those in the residential field. But we've been very successful in getting some legislation passed. We worked with Jaworski from Pennsylvania for about 7 years, and they passed 4173. And so I think it's October 18th is implement date that AMCs have to pay appraisers reasonable customary fees. And that's a big win for appraisers.
Yes.
Because traditionally, every time you put a middleman in, they seem to take all the gravy, and they don't leave a lot for the dog. And so we're letting them make their money off of somebody else's back now. So we've been very successful in that venture. And not all AMCs are bad, though, by the way. There's some very good ones, but there are some that took advantage of people. And that was a concern to consumers because they weren't necessarily getting the best appraiser. When you look at, can you get it back in 24 hours for $100, you can't expect much value.
Correct. Or much effort and research too, because sometimes appraising in a very difficult market like we have with dominated and lender-owned properties, it needs some time.
Well, I've been through several of these stages in the economy. In the last one, the savings loan bailout, was very similar but very different. And I think this is the most difficult time to be an appraiser, is in the market today.
What is it that you've been told about going in front of Congress? I'm just curious, as I've certainly never been there. I'm just wonder how that works, and do you feel that people listen to you? I'm just curious how it works, and what do you hope that you can accomplish for the industry?
Well, usually when they ask us to appear, they have specific items that they're relating to. And usually they're consumer issues because that's what we want to address.
Okay.
How we can best serve the consumer. I have not spoken before Congress myself yet, but our past two presidents have. So I'm looking forward to it, but I'm a bit intimidated by it on the same level.
They haven't filled you in much, or let you go with them?
Well, I'll tell you, the last time when Les Sellers was there, our current president, and Jim Amron, the president before him, they contacted us about a day ahead of time and said we want to talk about this and be there. And so fortunately we could be there, and apparently we did what Congress wanted. And so I'm looking forward to it. We have a very good research department. It takes care of a lot of information. They can bring us up to speed on talking points almost immediately on most issues.
Okay. Sean, I've just got to ask you, first of all, your take on the extent that we've taken care of the real estate problem.
Wow, big picture question right off the bat.
Yeah.
I look at it this way, just using Fed flow funds data. The Fed kind of keeps a balance sheet on the U.S. and in households. And we went from $4.5 trillion of mortgage debt in 2000 to $10.5 trillion at the peak. And if you look at the number of new homes that were added, the increases in income, I don't think we should have gone above 6.5. That means there's $4 trillion in excess mortgage debt that we created. And I think by the best case measure, we've adequately dealt with maybe $500 billion of it. I think we've got a long way to go until we have a healthy household, equity level again.
I have to ask a question. Aaron, there's something to forward. I need to get to some charts. I'm sorry. Commercial interruption. You wrote an article that made a little headline, Foreclosure Roulette.
Yeah.
So, yeah, you knew I was going to ask about that. A game of extend and pretend. So let's just talk a little bit about that. I'm going to need that clicker, by the way, because I got to go forward past this. Oh, you're looking for it? Go. Sorry. I didn't do this with Christopher, so unfortunately. Keep. Yeah, that's okay. We'll stop there. This is the foreclosure inventory and how it's broken out, where we have private label, if you will, and then the growth of Fannie, Freddie, and FHA. So that's the REO inventory. And I guess the question is, does it pretty accurately reflect the delinquency picture?
No. Yeah, I mean, we really had this, we had foreclosures kind of moving lockstep up with delinquencies until September 2008. And then the world changed, and that's when Secretary Paulson came out and said we shouldn't force banks to sell these assets in distressed markets. And after that, the foreclosure rates just completely disengaged with the delinquency rates. And ever since then, we report on the foreclosure numbers every month. And I hate to say this, but when really pressed, they say, what does this mean? What does it mean that bank-owned sales, properties that the banks took back went, up 20% last month? And at this point, I have to say nothing, because it'll be back down next month. We've been kind of bouncing around in a range that has nothing to do with delinquencies or anything else since then. Since they changed from mark to market to mark to model, since the FDIC loosened up on forcing, lenders to clean up bad assets off their books, we changed the rules, and ever since then, foreclosures have just stalled.
Christopher, I've just wondered what your take on that was. First of all, do you agree with that's what's happened?
Yeah, absolutely. I mean, the administration came out, the Treasury came out and tacitly admitted that their strategy for dealing with foreclosures was not to let them come out at once, to try to deal with some of them through some policy prescriptions, but otherwise just slow the process down. And, you don't want to, putting the frog in the pot, boiling pot, how it works. So, and that's what they've been doing more or less. Now, I think one of the interesting things, of course, is this program they're rolling out this fall, where they're going to have a new version of the HAMP. We're actually trying to incentivize the banks to write down the principal on the mortgages for the first time. And I think that's actually going to be a very interesting program, because there may actually be a few people out there who will successfully work their way through the program and may help some of that problem. But even so, there's going to be, maybe 3-4 million more foreclosures, all said and done?
I think more. We'll see.
Really? I don't know. I'm in the 3 to 4 million range.
Yeah.
So
my problem with, there's always a new program, and that's the method for extend and pretend, right? It's hold on because we got to do HAMP. And then, but HAMP had design flaws from the beginning. I don't ever think it was intended to be successful. And then hold on, we're going to do HAFA. And it had design flaws from the beginning, not intended to be successful. You're not going to fool me again with HAMP 2 PBR, principal balance reduction. It's not intended to be successful. Fannie came out and said, hey, we're going to really go after, folks that strategic default. And, what the banking industry, and I think what the federal government's worried about right now, is more people making a sensible decision to say, the average foreclosure in California right now, $150,000 upside down on a $250,000 house by the time it reaches the courthouse steps. There's a lot more folks in that situation, and I think banks and the federal government don't want more people making probably the right financial decision for themselves and walking away. And I think that's also the reason we saw Fannie's recent announcement of, hey, banks, start pushing through foreclosures. It's not because they're actually going to push through foreclosures. It's because they want people to think they will, so they don't strategically default.
Oh, I read the article. I called him up. I thought it was a pretty gutsy article. Let's talk about principal reductions a little bit. Tommy, what's your thought on that?
Really, I think I could go home because, Sean, I couldn't agree with you more. Well, first off, I do not understand how we could have principal reductions where, okay, we go into a neighborhood And in that neighborhood, we'll say 60% of the people in that neighborhood have paid their mortgage like they're supposed to. They're still in their house like they're supposed to be. And then we say the other 40% of you that did everything wrong, we're going to take 40% off of your value and put you in a much better situation. That will not work, in my opinion, in a capitalistic society. You have the beginnings then of total destruction. Let me say one thing.
Okay.
Your comments when we started, I think that you've come up with a variety of good ideas over the years. This is one time I think you are dead on. Things like assumptions of loans, yes, those are good ideas, but I noticed that you talked about a $150,000 home as your example.
Yes.
And one of the things that I've commented to you before, in my opinion, America is on a track, because of the book that I had you read, that really a $150,000 home is about what the average American can afford. And if that's what the average American can afford, then Sean is correct, because as we travel all over America, we're finding that people are trying to sell homes for $300,000, $400,000, and $500,000. And that's the real issue. In fact, I had a statistic recently that said that all of the mortgages in the United States that were $300,000 and more would equate to 5%. 5%. Well, now, folks, go out and see what they're trying to sell homes for, no matter where you go. And what are they building more of them? 400, 500,000? The market can't stand it.
Christopher, you said something in the interview that I did that I was just surprised by, and I just wanted to ask you about. You talked about builders, just in general, that just according to studies and so forth, that they have never built enough homes in California to keep up with household creation. Now, that's certainly not going to be true in 2010, I don't think. First of all, let's start there.
Right off the bat, you got to keep in mind that they haven't built enough houses. You go back to, say, 1992, basically, when the last collapse in building permits occurred. From that period on, we built maybe 70%, 75% of what you would need relative to population growth. Now, it doesn't mean we have a perfect match. The biggest problem is they've been building nice big homes in the Inland Empire when what we really need is sort of lower rent apartments closer to urban corridors, because that's the sort of population that's been moving into the state. So there's a big mismatch, but nonetheless a basic shortage still provides an underpinning to stability for building new homes in the state that place like Arizona, Florida doesn't have. But it is a mismatch. I mean, I tell people, yeah, we're going to need housing in 2011, 2012, but not high-end stuff.
Right.
It's going to be townhouses near bus lines. That's what you want to be building, and that's where the demand's going to be. And if you can do that, I think you can make a living at it. But you're dealing with zoning boards, you're dealing with local governments that are cash-strapped, looking for you to fix their sewers, their power lines, their streets, their everything, their pension. And so it's a problem. It's problematic.
Oh, pension. Okay, I'll bring that up later. Okay.
Sorry.
About commercial real estate, Daniel, I was just wondering now, how is the industry done in 2010? I mean, that's got to be one of the toughest years that industry has had, I would think.
Actually, 2010, we're actually making headways. I mean, if you look back to 08, there was almost no capital available, very little liquidity. Everyone was on the sidelines. In 09, some of those capital sources started to come back into the market. We've got more capital available to us today than we've had over the last 2 years. Our biggest challenge is that there's a lot of properties that just don't qualify for it. It's kind of the have or the have-nots.
Okay.
You've got properties that are performing, that are well located, well leased, not overfinanced, and those properties are probably garnering interest rates in the high 4s, low 5s. You have other properties that have leasing issues, and nobody will finance those at all.
Are they on sale? Or not just for sale, but are they on sale? In other words, that it's got to be affecting the price of the product, I would think.
Well, if you look at the properties that aren't performing are probably, well, the unfortunate part is most of those are still in the hands of the owners.
Right.
Because the banks or the note holders are not foreclosing on them, because in many cases, if they foreclose on them, they have to write them down more than they have the ability to write them down. And so they're just pushing it on down the road, hoping for... Now, we're starting to see some movement in that because of the zero interest rates that the feds have given the banks. They're putting it out in 3-4%, so they're actually making profits. They're actually taking those profits as quarter by quarter and saying, okay, we have enough in the kitty that we can actually foreclose, write down this asset, sell it, get rid of it. And so it's just going to be this long, drawn-out process of dealing with the bank issues, because there's nobody putting the gun to their head.
And that's different this time, is it not? I mean, in the 90s, it seems like the rules were sort of different. That there was the FDIC behind saying, no. I remember an article coming out where, and it did happen, as about 95, they just weren't foreclosing. You talk to people on the phone, and they'd go, yeah, I made a payment in a year. And all of a sudden, there was an FDIC bulletin that said, if you're 100 days behind, Fannie or Freddie, you have to put an NOD. And that was aggressively pursuing it, which is very different. Now I'm talking residential.
Right. Yeah. Well, from the commercial side, you had the RTC that were taking the S&Ls down, who had a lot of the debt out. And those issues were being dealt with. Property values plummeted. But over a 5-year period of time, we came back. This time from a commercial standpoint, because we're not dealing with the issues, we're going to be a long time to recovery.
Okay. Now, this chart here is taking a look at the maturities that are going to come due. So 2010 is pretty mild, 2011 is pretty mild, 2012 is not very mild. And when maturities of commercial loans come due, what do the lenders have flexibility?
It's 2012 plus.
2012 plus?
Yeah, because
okay, thank you. Okay.
Most of that's coming due
the next 3 or 4 years.
13, 14,
Thank
15.
you for noticing that. Okay, but it is the worst of the years. Okay, what is the flexibility that the lenders have? Can they just do what you just said? Can they just?
Well, a lot of that debt that's coming due in 2012 plus is CMBS debt, it's securitized debt.
Okay.
And so, that's being held by, bondholders. A lot of it cannot get refinanced or won't get refinanced.
Okay.
Right now, how they're dealing with it, and again, we're not dealing with a lot of issues right now, because if you look back to 2000, 2001, 2002, those were very small years. From a financing standpoint, you look out 10 years, we're there now. Mm-hmm. A lot of those loans that are not refinanceable are being pushed out 12 months, 24 months by the special servicers. So they're not dealing with those issues, they're just pushing them out as long as they can keep the notes current.
Okay.
So you got the same issue. So when the 2012 plus comes, unless values come back, because CMBS is coming back, so we've got securitized money that's starting to come back, but values are not coming back. So we have the problem.
Right, it'd be really hard to refi something at this point.
What do you mean values are not coming back and we have a problem?
No.
Well, if you in 2006, 2007, we made an 80% loan on an inflated value.
Right.
So the value of that property it may be 60 to 70% of what it was in 2007, but it's still got a loan on it that's at best case 100% to value, probably more likely 110 to 120% to value. So just the fact that we have money available to refinance doesn't mean that we can, because we don't have the values we need.
Right, but if you just close your eyes, hold your nose, and wait till 2014, you'll probably be okay. That's the game they're playing.
That's the game they're hoping on.
That's the game they're hoping on.
Right.
Now,
Can I ask you a question?
Go ahead.
I'd like to ask all of you this question.
Have you taken over again, Tommy?
No, I would like to know the answer.
Okay.
Last year, we went through a major change in the auto industry. Major. Closed, I don't have any idea what the right number would be, but literally thousands of automobile dealerships throughout the United States.
Well, not that many because they all fought back and most of them got reopened, but go
Well,
on.
no, since I'm talking to people that want to sell them, I'm not too far off.
Right.
So the bottom line is those dealerships are closed. They will not reopen as automobile dealerships. If you'll go to the places where they're located, I just picked one industry. What I think we do not face in America is the reality of major changes in our economic system. We talk about all of these things in what I call big circles, but the reality is, in that small town in America, there will no longer be a need for that auto dealer or a need for that drugstore or a need for that shoe store. That doesn't mean that that's a bad thing. I think Walmart and that concept, Lowe's, I think these have been great things for the American economy. But it has changed the paradigm of this economy completely, and I think we completely act like it didn't happen. We come up with everything in the world and look like Never Never Land is in the future, but no, we have to restructure the way we think. Now I ask you for the solutions.
Well, I mean, the first thing that has to happen is
What's the problem?
But what
What's
is
the problem? We've been going through change forever. I mean, when they invented light bulbs, the candlestick makers went out of business. When they invented the car, the horse raisers went out of business.
There's no problem as long as you agree that you go and sell that automobile dealership and maybe turn it right back into barrel
I mean,
land.
the reason they were closed is because they shouldn't have been open in the first place.
I agree with you completely, Chris. But we still go around trying to tell everybody that dealership's worth $300,000. No, it's worth $50,000.
Absolutely, and that's one of the big problems. You're right, we are going through a transition. I would agree with you 100% on that. It's particularly on the consumer side of the account. Now, this is a painful time. You think about so we've lost 8 million people, 8 million jobs in the U.S. 5 million of those jobs, 2 million came from construction, 2 million came from manufacturing, 1 million came from retail. Those 5 million people are not going to find new jobs anytime in the near future. This is a social crisis, though not an economic one.
I understand.
And I know that sounds awful to say, but this economy can grow with the burden of those folks for a while. And it's a social issue. We need to deal with that socially, and I hope we make the right decisions on the social constructs. But I don't think economically it's a problem.
Have you read the book, The World is Flat?
Yeah, it's completely wrong.
It's completely wrong?
Completely wrong. He's a journalist. He's not an economist, and I wish you stopped pretending he was.
Oh man, I really like the book. Now, let's go ahead. What would be the concept that you think is completely wrong?
U.S. incomes have been rising at the same pace for the last 45 years. China aside, it's been completely. The developed world has not been influenced the tiniest bit by China. Our lives have been made better because of these amazingly cheap products we get on a daily basis. And the vast majority of us, yes, there are some casualties, but for the vast majority of us, particularly these people in this room, our lives have been made spectacularly better by the rise of China. Now, if you go down to Mexico, it's a completely different story. They're the ones who got ran over. Why are the drug cartels taken over? Because their economy got run over by the SS China. Because they're the ones in the path of that battleship, but not us. The world isn't flat.
Now,
Mexico, it got flattened.
Our real income has gone up.
Absolutely.
In the last 10 years.
Absolutely. Okay. On average, the vast majority of Americans are far better off. Yes, the bottom 20% have been struggling forever, but even there, their standard of living has been more or less flat. I mean, today we got one horrible news. There's all these millions of people who are in poverty in the United States. Poverty in the United States means having an apartment, a car, television, free public education, and a decent amount of health care. I know it's hard to believe, but we got a lot of public health care in this nation.
Now, I remember...
It's really not, give me a break. Will you go live in Somalia? You want to hear if you have tough times.
So you're not concerned about, and this is one of my legitimate concerns about when you have inflation, let's say, and that ends up happening, but you don't have the ability to ask for more for the car that you were going to build because somebody has an import that's half of what you could do it for. How does that not have an impact? They just have to find another industry that's...
Yeah, change. I mean, it's just change. The world's all about change, and the change can come from trade, it can come from technology. Again, look at all the candle makers who lost their jobs because of the light bulb. Are you going to hold back progress? No, we can't have the light bulb. All these guys have this wonderful pension. If you don't buy candlesticks, they're going to lose their pension. I don't care about their pension. Give me the light bulb.
All right, you brought up pension twice. Next time I'm going to ask you about it. Here, I just finished reading a couple books. I think it was On the Brink and something, The Big Short, okay? And what's interesting is what you just said. All of this big chart is commercial mortgage-backed securities. Are there any collateralized debt bets against that stuff?
Are there any what?
Collateralized debt obligation bet? I'm sorry, CDSs.
CDOs.
No, CDOs are how they financed it, but the bets against it were a credit default swap.
Oh, you're talking about the CD.
Yeah, the thing that sunk Lehman. Yeah.
Swaps.
Yeah, well, weren't they able to bet against?
Sure.
Is that a concern? I mean, seems like it should be.
You know, I know they're the weapons of what do they call them? Weapons of mass destruction. The whole market, and is it a problem?
Well, wait a minute. Was it a problem for the residential world?
No. There's two different issues here.
Okay.
Okay. There's the real world and there's Wall Street.
Okay.
And when everything went to hell in a handbasket in 2007, it was because we had big problems in Wall Street and we had big problems in the real world. The problems in the real world, people were spending too much money on homes they couldn't afford, and they were spending too much money they weren't saving, and they were creating this huge trade deficit. That's the real world. The financial world, these guys were playing this Russian roulette, going crazy, leveraging up, making tons of money, and when it all blew up, they said, thank you much for our billions, and they walked away. That's just the greatest train robbery in the history of the United States, and we need to prevent that. But that's different from the real world. Don't confuse those two issues.
Okay. No, well, I don't want to say that train wreck isn't ready to occur again if there's those kind of side bets again.
Absolutely. Could possibly, yeah. But I mean, it's all, we have to do something to control the volatility in Wall Street. There's no doubt about it. It's not just those side bets. It's this, millisecond trading where they're all trying to go at the speed of light, and we get these flash crashes. And it's this thing, this commercial mortgage-backed security crap. Who needs that? We never had that before. We had plenty of bubbles, but no, we needed that to have a world-class bubble. You know what I mean? We couldn't have bubbles without that, right? I mean, give me a break. This stuff should go away. We don't need that stuff.
Well, now, you seem like it was helpful to the industry.
I think it was extremely helpful. I mean, CMBS came in 1995.
But we had commercial real estate markets before then, right?
We had
developed in the 80s, developed in the city, right? We built Empire
we lost
State
several
Building.
sources. The savings loans went out. A lot of the life companies went out. The banks weren't lending. We had no debt available to us in 1995. So, that was a great thing that we don't have any debt available to us. Well, somehow we had to create some debt for commercial real estate. The CMBS came on, and throughout the end of the 90s and probably into 2002, 2003, it was a really good thing. It was before the advent of the CDOs, using the CDOs to take the BP Spire out of the equation. Prior to that, you had someone who was actually taking a risk, making a bet that mortgage would do. And somebody watched it.
I'm really talking more on the CDO side, so
right.
I apologize if I was throwing out the
But the CDO came about, and then nobody had risk on the table. Yeah. And that went away, and then the CMBS market just went crazy. Too much debt came in, which created too much value, and it was kind of the snowball that was on its way to explosion.
I mean, I really think you had two things that changed the risk. Right? We repealed Glass-Steagall.
Right.
Right. So we let federally insured banks start playing, these games and play with mortgage-backed securities, play with all these new toys, right? All these shiny new toys, and then the Commodities Futures Modernization Act that'll let all these guys pretend they had insurance, right? So now they have to go out and create as many risky products as they can with no risk themselves, because at the end of the day, it all comes back to the taxpayer.
If I will, I agree with you 100% on that, except for we also have to keep something in mind, that the three biggest losses to the American taxpayer are not insured banks. It's Fannie Mae, Freddie Mac, and AIG.
So far, right?
So far. But those are the three biggies that, in
Well,
terms
we've
of
propped
taxpayer
up.
money, and none of all those came out from a different part and weren't insured at all, and we're picking up the tab
But that's
anyway.
only because we've given those big banks essentially free money, interest-free money, right? Let them go out and generate profits again, and let them not take any losses. Let them push through all the losses, and then let's see where the big losses really are.
But if you, but Fannie and the size of Fannie and Freddie. If you just look at the sheer size of Fannie and Freddie, I mean, they're like the whales in the land of these. I mean, they're the
one 1/100th, 1/1000th of the total derivative
Yeah,
bets
but
out
in
there?
terms of sheer financial weight, the trillions and trillions of dollars they represent of debt in the system and over leverage in the system is just enormous. They dwarf the commercial banks in terms of their sheer size. And so even a 2% loss on a Fannie and Freddie is equal to wiping out half the commercial system.
But
the
you
scale
have
is
bets
completely
on
different.
those losses, right, in the derivatives
But
markets
my only
that
point
far
is
exceed them
the
that
taxpayer is still
banks
picking up
hold.
the tab. And it has nothing to do with insured banks. All the way around, we were overexposed to these giants who were too big to fail. And
So
that's
the
what
banks
problem
have no
is.
derivatives products that they have potential liability on.
I don't know what that has anything to do with what I just said, but anyway, okay.
Well, but that's my point, right? So if banks have derivatives, et cetera, that they potentially pay on in certain situations, which we don't know.
Well, I mean,
Those things aren't
derivatives
open.
in a limited form are worthwhile. I mean, I think
Right.
that if you're going to get involved in the derivative, you should own the underlying asset the derivatives will leverage against. You shouldn't be allowed to go out and just throw out
But we
random bets.
deregulated
We
them
know
and we
that.
didn't do that.
Right. Now, I agree with that. There should be controls on the system, but
Okay.
what I'm trying to say is only part of the
We
problem.
might be losing
right.
the audience, but I want to, so
Lost, yes.
No, this is a pretty sharp group. But, okay, explain what a derivative is and why it can get out of hand if that's, I don't care who takes that on.
Go ahead.
Well, I mean, derivatives is where you're basically taking a side bet in the financial system, right? So if I'm going to buy a bond, but then I need to insure myself against a failure of this bond, I may go out and buy a CDS on that. And that way, if this fails, I'm okay because I'm balanced over here. And I can see that kind of attraction. The problem is if I buy this and then these four guys all start buying it. And the problem is there's so many cross bets going on in the system. Now, even that's not bad because you could say, oh, it creates a complete market. The problem with the idea of a complete market is it assumes the counterparty risk is zero. And what that means is no matter what, you get paid back.
Right.
There are other parts of the system right now which has fundamental insurance. The stock market, for example, the whole point of the New York Stock Exchange is they basically insure the transactions. If your counterparty collapses, there's somebody there to make sure that you're made whole, and that's what keeps the market liquid. The problem in these derivatives is we didn't have that. And so if you had, we had the failure of Lehman, what it did was it sucked down a huge part of this derivative market. Suddenly there's no counterparty. And that's what creates the complete lockdown, total panic of the financial markets, blood running in the street, and next thing you know, nobody can get a loan for anything at all.
Chris, let me try just one more here. So think fire insurance on my house. I can buy fire insurance for my house. It protects me if my house burns down. Okay? What if everybody happens to know I'm a pyro? Right? I'm lighting off fireworks and I'm going crazy with fire every time. And everybody can take insurance against me losing my house when they know I'm a pyro.
That's the
derivatives
wrong
market.
example, because what if I know you live in a house made out of straw?
And
that's
I'm a
dry.
pyro.
and you
I'm a
keep a
pyro.
garage full of turpentine.
Right.
And I buy insurance in your house, and maybe I just happen to drop a cigarette next to your garage one day. That's,
Probably closer.
yeah.
All the people, though, that bought that insurance policy, if there was a backing to that or a reserve to that, we wouldn't have the problem. The problem AIG
Counterparty
did
risk.
is they were making all these policies, but they had no reserve, no backup for it.
Right.
So it all went down.
Because if they were forced to have a proper amount, they
Right.
would have charged a lot more for it, which would have prevented this problem from happening in the first place. So it all boils down to counterparty risk. Too big to fail, that's what needs to go.
I just want to, this is a tough thing maybe to kind of get your head wrapped around, but this is the core of the whole deal.
Okay.
This is how we got this huge run up in debt and how we got this huge run up in prices.
Let me just, and we're going to close the first section with this. When my daughter got married, it was the first time I understood a credit default swap. It's a weird way to find out. Where she got married, they sent me the bill, and they sent this thing that you could insure against, like, what if your wedding didn't happen? You're writing this big check in advance. So I went for it because it was 1%, and I filled out the application, and it got to, okay, who are you in the transaction? And I'm the father of the bride, but there were a few other choices, including other. And I thought, how interesting. I wonder if they would cash 1,000 other checks on the bet that Sarah Norris's wedding didn't take place, and those guys didn't write the original check. And the answer is some insurance, whatever, they look and say, this is a profitable business model, cash all 1,000 checks for one wedding, you'll be fine. That's literally what the system did, only the problem is Wall Street purposely put bad stuff in some of those and bet against it and became very wealthy. What was really distressing about some of these books is both sides. became wealthy that made the bets. The people that bet wrong were on commission, and they were making tens of millions of dollars knowing they were going to lose people's money. And the people that bet right made tens and hundreds of millions of dollars, but on a device that wasn't allowed. It used to be called bucket shop in the early 1900s. All right, hopefully we've had a fun first half, and we'll thank you.